All right, guys, today we're going to be talking about Chapter 7 review. I'm Taylor Novak.
I'm Olivia Nash.
So the first slide is about price markups. For price markups, it's easy to mark up prices when there are little competitors because if you control the market, then there's no one that's setting lower prices, so you can set it as high as you want. Markups are easier to do within differentiated products because they're differentiated, they have special features, so you can make the product a little higher.
So for luxury items, so say shrimp is considered a luxury item and consumers are willing to pay for that. The strong perception of value allows retailers to maintain or increase shrimp prices despite decreases in wholesale costs.
And for cost-based pricing, under cost-based pricing, a markup rate of full cost is determined and then added to the product's costs to establish price. The markup rate could be on the desired target rate of return on investment.
So for marginal pricing, the price is not covered. Let me restart that. Does not cover the product's total cost of the product, but instead includes only the marginal variable cost of the producing the product to be sold in the export market.
And so in the review, there's a question about FOB transactions, and the question reads, the seller agrees to deliver 300 tons of coffee to buyer FOB Port of Montreal, Canada. The goods are transported and unloaded at the port and kept at the customs shed for inspection and payment of duties. The buyer is notified of the arrival of merchandise and its location. Before the buyer picks up the goods, the customs shed, including the merchandise in it, is destroyed by a fire. The buyer claims refund of the purchase price, stating that she did not receive the goods. And then the question is the seller responsible?
With FOB transactions, the seller is not responsible under DAT or DAT. The seller is responsible for export clearance and the transport costs up to the named place of destination.
So again, back to the review, there's a question about CIF contracts. A seller in New York agrees to ship goods to buyers in Lima, Peru under CIF contract. The seller goods are loaded on the ship and seller tenders the necessary documents to the buyer for payment in New York. The buyer refuses payment, claiming that it will pay only after inspection upon arrival of the goods at the port of destination. Is the seller entitled to payment before arrival of the goods? And the answer is yes, the buyer has the duty to pay upon the presentation of documents by the seller.
So with CIF contracts, CIF or cost insurance freight is basically where the seller is to arrange for carriage by sea and to pay freight and insurance to a port of destination. The seller's obligations are complete when the goods are placed on the ship at the port of destination.
Now for DDP contracts. DDP is delivery duty paid, and it's where the seller delivers a good to a specific location, still loaded, but ready to be unloaded at an agreed place of destination. The seller is responsible for all costs and risks to bring the goods, like duties and taxes for import, in the country of destination.
So Incoterms 1990 versus Incoterms 2000. The Incoterms 2000 places the responsibility for export clearance on the seller in FAS and requires the buyer to clear imports to own expense in DEQ terms. And it obligates sellers to load the goods on buyers' collecting vehicle and under FCA terms, and the Incoterms 1990 does not.
And there are some limitations of Incoterms. The limitations of Incoterms are they only deal with the matters pertaining to the interpretation of terms of delivery. The rules do not deal with transfer of property rights in the goods, exemptions of liability, or consequences in cases of breach of contract. Incoterms deal with the obligations in connection with delivery, insurance, provision of documents, and clearance of goods for export-import operations.
So for Incoterms 2000 versus Incoterms 2010, Incoterms 2010 rules are divided into two broad categories, while Incoterms 2000 are divided into four categories. The Incoterms 2010 rules of any mode of transportation and rules for sea and inland waterway transport. Incoterms 2000 focuses in departure, main carriage unpaid, main carriage paid, and the arrival. The Incoterms 2000 refers to the ship's rails as the reference point of delivery, while Incoterms 2000 provides that delivery happens when goods are on board of the vessel to reflect commercial practices.
Incoterms 2010 also focuses on changes in relation to insurance over security-related clearance and string sales. Incoterms 2010 have 11 terms, while Incoterms 2000 have 13 terms. Incoterms 2010 is introduced in two terms, DAT and DAP. Incoterms 2000 replace four terms including delivery at frontier, DAF, delivery ex ship, DES, delivery ex quay, DEQ, and delivery duty unpaid, DDU. And so now we're going to talk about the case, in what cases would export-import managers prefer to use FAS shipment term? And the answer is in cases where export-import managers prefer to use, in cases where export-import managers require the seller to deliver goods to a named port alongside a vessel to be designated by the buyer. FAS is appropriate in cases where sellers took their shipments to the pier and deposited if close enough for uploading. And now we're going to talk about Chapter 7 case.
So the case actually is just a paragraph, so I'm actually going to read it because it has a lot of important details to understand it. A contract of sale was entered between an American company, BAT Inc. of Calumet City, Illinois, that's the buyer, and the German scientific equipment manufacturing firm Tolla Seller, which is the seller for them, for the sale of mobile MRI machines. Tolla sent the requested MRI machines in good working condition to the buyer aboard the ship, Superior Carrier. However, when it reached its final destination, it had been damaged and was in need of extensive repair. The buyer and its insurance company believed that the MRI machine was damaged in transit. BAT's insurance company, St. Guardian Insurance, covered the cost of the damage, which was $350,000. In turn, the insurance company intends to recover from Tolla. However, Tolla claims that since the goods were shipped under CIF terms, it is under no obligation for the loss, and that it is contractual obligation with regards to risk of loss ended when it delivered the machine to the vessel at the port of shipment. The buyer's insurance company contends that Incoterms were
inapplicable.
Thank you, since they were not specifically incorporated into the contract. They also argued that the seller's explicit retention of title modified the risk of loss. So what we ended up agreeing with is we decided that BAT and Guardian Insurance was actually right because the retention of title was modified for the risk of loss, and Incoterms does not cover transfer of titles. Tolla claimed CIF would not be covered.
All right, guys, before we get into the case analysis, we're going to do We're going to review Incoterms a little bit. So Incoterms 2010, Group E is for departure, and that means the seller makes goods available to the buyer at the seller's premises, and that includes EXW. For Group F, it is main carriage unpaid, which the seller delivers goods to the carrier nominated by the buyer, which includes FCA, FAS, and FOB. And then there's Group C, which is main carriage paid, and that is when the seller contracts for carriage of goods but does not assume the risk of loss after shipment. And that includes CPT, CIP, and CFR, and CIF. And the last group is Group D, which is arrival. The seller is responsible for all costs and risks required to deliver the goods to the destination, and that includes DAT, DAP, and DDP. But the case. So the main problem is who is responsible for the goods, the damage of the goods when in transport. Some relevant facts are that Tola shipped an MRI machine to America for BAT Inc. aboard a ship. When the ship reached the destination, the MRI machine was damaged, and Tola tried to claim that CIF, but it was not explicitly stated in the contract. So one alternative course of action would be that CIF does apply to the transaction, and then in this case, Tola would be they would not be responsible. CIF transfers the risk from the seller to the buyer at this destination of departure, and BAT would have to suffer the loss of the damaged goods. Another course of action would be that Tola could try to claim CFR, in which case they would also still not be responsible for the damaged goods. For CFR, the transfer of risk is when the goods are placed on the vessel, and Tola would not have to pay, and BAT would still be responsible for those damaged goods. The third course of action would be Tola could also try to claim FOB, in which case they would not be responsible for the damaged goods. For FOB, transfer of risk is when the goods are placed on the vessel at the place of departure, and Tola would not have to pay, but BAT would still be responsible. And so our kind of decision was that since CIF was not stated within the contract, that Guardian Insurance should be able to recover from Tola. To solve this, Tola will pay for damaged goods. In the future, it is best to state Incoterms in the contract whenever you're doing any kind of transaction overseas, or just even if it's within the United States, you should always state the terms of the transaction if in case anything happens. So I hope this review helped y'all. I guess we'll see you the next chapter we have to present. Thank you.